Alrighty, g'day traders. Tonight what we're going to be doing is looking at part two of this series that we've been looking at, and that's risk models. And having a little bit of a closer look at how the professionals approach the market. So in this part, three-part series, basically part one, which is now available on the website, is introducing the idea of risk modeling or money management and just breaking it down a little bit more further and looking at what the professionals do and really looking at trading as a basis of what you risk per trade and learning how to express trading in what we call R multiples, and also working out expectancy, strike rate, and a few of those things, which I will touch on again tonight. But certainly any of those things can be Googled if you want to find out a lot more information about it. I really suggest a book too that kind of this is where this is all based on, and that book is called Trade Your Way to Financial Freedom by Van Tharp. Last name spelled Tharp. But yeah, so part one of the series was just introducing the idea. Tonight, part two is going to be more taking those models or taking that idea and kind of working our way back and determining exactly what we should be trading based on position size of per trade. What tends to happen in the marketplace is people are just given sort of random position sizes, or they just base it on something that's very random or a roundabout figure. Where really what we should be doing is taking it and working it out from a scientific or mathematical perspective, and really got to take into consideration your conditions, your personality, your trading capital, and from there start to work backwards. So we'll be elaborating on that tonight, and then part three, which will be available on the member site soon, basically just takes everything we looked at in part one and two, and taking a real example of how I do it and using a few things from my trading model and just putting some real figures in the situation, and that would be a great way to wrap it all up and hopefully make it a little bit more easier to understand. So just before we get started on it, I want to go back to basically the pie chart that we started with right at the beginning of part one. I didn't create this pie chart. This is something that's pretty much out there throughout trading, and most traders, professional traders, will look at trading this way as far as your entire strategy, breaking it down into three major parts. Now, what tends to happen is we tend to focus on the systems or the entries, but once you really start to break it down, you realize that entries, although it is important, they're a very small piece of the pie, so to speak. And what needs to happen is there needs to be an entire risk model or a money management system that wraps around that entry or the trades that you do take. And as this pie suggests, creating risk models and things like that is 3-4 times more important. And what tends to happen is there's not a lot of information. It's not discussed a lot risk models, and there's many traders that have been going many years and haven't really heard of some of these terms within risk model, and that's creating expectancy and writing your trades down as far as R distribution and things like that, which we will touch on tonight. And the reason for that, I guess, it's not tends to be as flashy. Like, you'll fill a seminar or you'll fill some seats quite easy if you want to talk about the next best system and how to enter it. But when you really break it down, look at the professionals, what they do, it's not the be all end all, and there needs to be a lot more focus, and you'll start to make a lot more progress and certainly feel a lot better about your system if you can create an entire risk model around the outside of it. And then of course that links back to this biggest part of the pie, which is mindset or psychology, and being confident within yourself that you can definitely conquer these markets. And creating this risk model part of this big red section will go a long way to increasing and developing your mindset, which absolutely that needs to be front and center, because without mindset, without the right thinking, it doesn't matter what we do in trading, it's going to be very difficult to move ahead. Alright, so like I said, what I want to do, as far as talking about determining position sizing, is really break it down and present it to you how, after doing some further research about this, how the true professionals, fund managers, CTAs, the big guys within trading, how they go about attacking their trading strategies or their way that they enter into the market as far as position sizing. So what they really start to do is, let me bring up a picture here just to kind of get into what we call R or risk, and basing your trades and your position sizing and what you're going for based on how much you're actually risking every time you go into the market. So for example, let's talk about R for a second. Now, every time, if you've got a set figure, now everyone should, when you take a trade, you should have a set stop loss. That might be 5 ticks, might be 10 ticks, it might be 200 ticks. It depends on the length and the size of your strategy, but whatever your maximum stop out is, that represents a 1R risk, meaning 1R, that's your full potential risk, and then whatever you gain in relation to that, or lose in relation to that, is what the trade ends up being. So for example, if you risk 5 ticks every time you go into a trade, and in this particular case you go for 10 ticks and you make a 10 tick trade, what you've done there is you've made 2R. You've basically made twice what you're prepared to risk. If it goes 5 ticks, that's a 1R trade. If it goes in your direction, you move your stop loss and say it comes back and hits you out for say negative 3 ticks, you can work out that's about a 0.6R trade. You've risked, or you've lost 0.6 of what you're prepared to risk within the marketplace. And as you can imagine, you add all those R values up, divide it by the number of trades you take, and you start to get a figure as to what percentage you're making in regards to what you're risking within the marketplace. So what I'd say here, moving on, a couple of questions. So what do you risk? So when you think about it, how did you determine the amount that you risk? Was it a figure that someone else told you to do, or was it something that you just plucked out of the air? Is it something that you have taken into consideration all your circumstances, your capital, and really worked backwards and decided on a specific figure based on your circumstances that you should risk every time you go into a trade? So I'd ask you first of all, because that's what tonight's all about, have a bit of think about that and how you originally came up with that figure. Because what tonight's going to be about is taking your annual objective. So again, I'll be asking you to have a think about what do you want to achieve within a year, and then basically backing it all the way up and determining what you should be risking each individual position size, or what you're prepared to take on as far as each individual trade. So just before we move on, just a bit of an overview, or back to part one for a second, and that's sort of the essential variables of a risk model. Now this is major part of trading. When you really break it down, this is what the professionals truly focus on as far as what they need to know about their trading system or their risk model. Okay, so it's basically 4 different variables here, which I'm going to break it down to you. The first is winning losing percentage of your method. So obviously that's your strike rate, or in professional terms what they call this is reliability. And quite often what happens is it tends to be all the focus is on reliability. How many winners are you getting and how many losers are you getting, and people want to really focus on trying to get 60, 70, 80% because they want to be winning more often. But when you start to really look at it, that's not the most important thing, and there's a whole lot of other variables that come into the factor. The second part there is frequency. So how often are you taking the trades? Now when you start to determine expectancy, which I'll chat about in a sec, what really changes as far as what kind of return you're going to get on your investment per year really comes back to how often you're taking that trade. So you can work out roughly how often you're winning and what's the average of your wins and things like that. But what you really need to know then on top of that is how often you're taking the trades, because then you're multiplying anything that you're making times by frequency, which is the number of trades you're taking, per month or per year. These second, third and fourth line here, this is expectancy. Okay, I'm going to touch on a little bit more about this. Basically what it is working out, when you do win, what's the average size of your winner, and when you lose, what's the average size of your loser, okay, and expressing it in R multiples. So like we said before when we brought up that dome, for example, your maximum risk is 5 ticks, okay, so you might take, for example, over 20 trades, you might have 11 losers, and 4 of those were 5 tickers, some 4 tickers, some 3 tickers, some 2 tickers, whatever it may be. Then you add up all those losses, and then you can start to express it in an R value, and what you might add up to is a total of, when you break it all down, is 0.8 of an R, meaning every time you go into a trade and you lose, you stand to basically lose about 0.8 of what you initially risk. Okay, and what happens when you start to work that out on a losing basis, on your winning basis, you can then actually times that by the amount of times you do win, the amount of times you do lose, and you can work out with a pretty good idea of exactly how much you stand to make every time you take a trade, whether it's a winner or loser, and that's to do with expectancy. Okay, so what's your average win when you do win, what's your average loser when you lose, and this I'll be expanding on more in a sec. And then max drawdown potential. We'll discuss this at the end, but really kind of understanding before it happens, what's your potential worst case scenario. So if you're already dealt with the fact that you can go through a string of losers, so let's say for example, you have a system that does produce 60% strike rate, for example. Now within that 60% strike rate, you might take 200 trades in a year. It's very likely that within that 200 trade sample, even striking at 60%, you could come across a string of losses of 10 trades in a row, for example. So based on, and we're talking about tonight, determining position size, based on your position size, even though you have a system that produces 60% trades that are correct, are you prepared to be able to handle one of your worst losing streaks? So you're going to come across winning streaks, but of course you're going to handle losing streaks too. So can you take 10 losing trades in a row, or working out based on your model how many potential losing trades in a row you can have? But we will talk about that at the end as well. So from this, when I started looking at this and understanding the variables of a risk model, and I certainly straight away said to myself, okay, I absolutely need to know all these figures about my trading. I need to be very clear about them. And what I realized straight away is, to be able to do that, you obviously need a system or approach or a method in the market that is very systematic. As in, I'm not talking about automatic, I mean systematic, where it's very clearly defined, so you keep on taking the same areas. So you can then back test or forward test. So go through, say, a period of 6 months, and based on every trade you take, start recording this information, and then from there, obviously the longer you record the information, the more solid the results are going to be. But you can imagine, if over 6 months you're very clear on exactly where you enter into a trade because you've got a very systematic approach, well, then you can work out exactly your winning losing percentage, your frequency of your trades, your average winner and loser, so your expectancy, and then what could potentially be your maximum drawdown. Go back over and go, okay, what was my worst losing streak? And then once you start working out these figures, you can put it all into some of these models and formulas that we're talking about, and have a really good, clear idea as to how you're going to move forward in the future with your trading. Okay, so that's the first thing. You absolutely need to have a systematic approach, and of course, none of this is going to work unless you do. And I don't know of any professional trader that doesn't have a very systematic approach. You just don't hear of people that are very discretional, or that just enter wherever they feel like it, without some sort of model or some sort of approach. Those type of people don't tend to last long. They tend to blow up their accounts and they're gone. You never hear of them again. The other thing to realize about this as well is you can change each of these variables within the risk model. Okay, if you've got a trading strategy, okay, as long as it's a robust, systematic approach, you have the power to change the winning and losing percentages and your expectancy. I'm actually starting to do it with my own trading plan at the moment. What I mean by that is, you're not taking any different trades. You're taking the exact same entries. But if you start going for bigger wins, or if you start, say, pulling out some of your contracts earlier, so you're getting to break even earlier, of course that's going to alter your winning losing percentage. It's going to rise or fall. But then based on that, you're going to have bigger winning trades, if you're going for more trades. But as a result, a lower winning percentage. Or if you start going for smaller trade, you want to lock in a bit more profit, you might start having smaller average winners, but your winning percentage is going to start to increase. Okay, so this is where creativity really comes into it. And you can, at the end of the day, once you're collecting all this data, you can determine what these figures are for yourself, any way you like, and you can really change them. And that's something I'm exploring at the moment, is looking at, just not settling for what I think is the best, really taking the information from my system and going, okay, let's record everything that happens over a 6 month period, go back over and go, okay, if I did exactly this would have been my greatest potential to pull out profit. And then basing it on that real information, that real data, I can then work out what's best for me in my trading plan to pull out the most profit. It doesn't necessarily mean getting a higher winning percentage. Like I said before, it's not all about winning percentages. There's a whole heap of other variables that are just as important, or if not more important. There's probably nothing really more important than expectancy, and that I'm going to break down a little bit more in a sec. Okay, so just before we move on, what I've got here is a risk management spectrum. Meaning, have you sat down, and what I'm going to ask you soon is, what is your annual objective? You never start trading, or you never start setting off on any sort of plan unless you have an objective at mind. It doesn't matter whether it's sports, whether it's business, trading, you always have an end goal in mind, okay? So an end of year objective, for example. Okay, now considering what you're aiming for, that's going to be based on what you've got to be prepared to risk. Okay, for example, if you're looking to create 20% return in a year, that's quite a small return as far as someone like us that we're trading our own capital. Someone that maybe a self managed super fund or something like that. Obviously, if you're going for 20%, you should be in a situation where you're never prepared to risk more than 5-10% of your capital. Okay, so it's very low risk trading, but in the day the reward is nowhere near as high. You go to the other end of the scale. If you're aiming for 200-300% plus per annum, you've got to understand that to get those sort of figures, and I'm not saying you can't get those sort of figures, but you've got to really understand that to get 200-300+%, you've got to be prepared to go through some massive swings of winners and losers, and that you've got to be prepared to risk massive amounts of your account, and maybe even potential where you're losing up to half or three-quarters of your account. And I got there just as a bit of fun, like a Mercedes fund or something like that. Someone, a high net worth individual that already is very quite well set up, and they're prepared to come into this account, into these markets, just to get a high leveraged account and possibly trade some spare money to get some toys or something like that. And then of course in between, going for something like from 50 to 100 or maybe 150%. Someone like myself, I consider myself a full-time trader where I'm just looking to get leverage. I don't want to have massive risk. I'm not prepared to risk losing more than 25-30% of my account at any one time, so maximum drawdown. But also I want a pretty decent return. I'm not prepared just to settle for say 20% within a year. I'm looking for 50 to 100%, and I'm going to risk say 15 to 30% of my account at any one time, meaning my maximum drawdown. As far as my worst losing streak, I stand to possibly have a drawdown of where I maybe lose 30% of my account, but then I of course always come back and make higher highs from that. So that's a bit of a way to look at where do you stand on that risk management spectrum. So ask yourself this figure. Where do you sit? Are you someone that does want a very tight spectrum as far as risk? So therefore, are you going to go for a small percentage, or are you got a bit more money to play with, and you are prepared to have a lot higher risk for a lot higher return, or are you somewhere in between? I think most people would lie somewhere in these couple of here, 20 to 50%. If you're maybe a little bit more conservative, I think on average 50 to 80%, maybe even up to 100% is a good figure, and then maybe 100 to 200% if you bit more out there and prepared to risk it a little bit more. But have a think about where you lie on that spectrum. Okay, so with that in mind now, what I'm going to have a look at is, you got your annual objective, 20%, 100%, 200%. And what I want to do is take some figures that you can absolutely calculate from your systematic approach, and then start to work back and determine what we're going to trade per trade, or determine our position size on an individual basis. Okay, so this formula, we're going to break this down, is basically your annual performance. So what you want to achieve a year, say 100%, equals your trade frequency, the number of trades you take per year, multiplied by, in brackets, your position size of individual trades, multiplied by expectancy. Then what we can do, so if you know expectancy, okay, which absolutely, that's what we talked about before, your average winner versus your average loser, okay, and we're going to actually go through and calculate that, but it's very easy to work that out. You could get an idea of that figure pretty quickly within a few months, or certainly back test. If you've got a very systematic approach, you can then back test and go, okay, this is what would have my expectancy would have been this based on how I trade the market. Okay, so it's very easy to work out that, and we'll do that. You can obviously work out trade frequency. Again, it's just looking at your systematic approach and going, okay, I'm taking this many trades on average a week, multiplying that by the number of trades weeks that I trade within a year. You're taking 10 trades a week, you're trading 40 weeks a year, you give yourself 12 weeks off a year, that's 400 trades a year. Okay, and then of course annual performance, that's a figure that you have to sit down, have a really good think about based on your risk levels, your personality, your capital, what do you want to achieve within a year, okay, and you can easily work out your annual performance. So if we can understand those three things already, then it's just a matter of math, of working out, breaking it all down and determining what we need to have as our individual position size per trade. Okay, so let's take this step by step. What I'm going to do here is, obviously annual performance, very easy to determine. Trade frequency, that's just a figure as well. All of you probably already have that idea of that figure in your head already. If it's not based on on an actual risk model, you should roughly have an idea of that figure, and if you roughly understand it, start with that. But then certainly start to record all this information and work out your trade frequency based on a more specific approach. Okay, so those figures are quite easy. We're determining position size, so we don't know that yet, and expectancy is the next figure. So what I want to do now is step one is go through and break it down and work out expectancy with you guys. And like I said before, what we're going to do in part 3 of this series is actually bring some real figures and kind of have a little bit more, take a real example of these situations and plug in some figures and work out some real expectancy. and then once we worked out expectancy, working out some annual performance objectives and position sizing as well. So let's start with expectancy and have a look at that. Okay, so up here I've got a spreadsheet. Now I've got the expectancy formula up here. So this starts to get a little bit more complicated. Stick with me. The good thing about it, a video like this, you can stop and rewind. You can also, I really recommend Googling it as well. There's lots of great information about different guys that express this, the same sort of concept, but explain it a few different ways. I've heard of a few different analogies to explain it, but we'll go through it now. So basically, expectancy. Okay, so we're working expectancy. What we want to do is take our average winner expressed in R. Okay, and I'll bring up some example numbers soon, but take our average winner, multiply it by the percentage of times we're winning. Okay, so what they're going to do is say, your average winner is 10 ticks and you're winning 60% of the time. Well, then you can start to work out, on average, when you're talking about your entire trading plan, what you're winning. Sorry, let me start again on that one. What we want to work out is every time we take a trade, what we stand to make or lose. Hopefully it's that you're making money. When you average it out over many trades, what you stand to make. Okay, so by determining our average winner times by the amount of time we win, we're working out the winning side of things. From that, we want to subtract our average loss, expressed in our variables, multiplied by the times we lose. Okay, now if I bring up a bit of some figures here and explain this, it will start to become a bit clearer. So let's have a look at an example here. Okay, up here I've got, basically some trades, some example of 8 trades. Now obviously with this kind of example, the more information you have, the more consistent your results are going to be. If we're just basing on 1 month or 8 trades, obviously you can really vary from that, but this is what we'll do for example. But if you can base your actual information on 6 months of data, a year of data, or even longer, at least 50 trades to 100 trades, that's where the situation want to be at. Okay, so here I've got, for example, 8 trades. There's a 5 tick gain, 10 tick gain, 5 tick loss, 3 tick gain, might have moved our profit up a bit. It's come back and hit us. 5 tick loss, 5 tick loss, 10 tick gain, 5 tick loss, 7 tick gain. Okay, now expressed as R multiples. Now remember, very simple to work out. Let me bring up the dome again. Okay, if we're prepared to risk 5 ticks, in this particular example, maximum risk is 5 ticks. Okay, of course, sometimes there might be a 6 tick or 7 tick loss. Things happen that out of our control, might get a bit of slippage or make a mistake. So be it. So occasionally you're going to get a bigger than 1R risk. But what you should find is you're never risking more than 1R, and it's either that or less. Most times taking into consideration that you will have a few times when a few things go against you as far as dome failure or something along those lines. Okay, so based on the fact that we're prepared to risk 5 ticks, what we make or lose, that's how we can work out our R value. Okay. So in this particular case, we've made 10 ticks, so that's twice as much as what we're prepared to risk. Okay, so that's a 2 risk times 2 what we risk trade. So it's a 2R trade. Here we've lost our full potential, 5 tick loss, so it's a negative 1R trade. Here we've made 3 ticks. Okay, so 3 into 5 goes 0.6, so it's a 0.6 gain. Here we've lost 5 ticks again, so it's a 1R loss. Another 1R loss. Another 2R gain. Another 1R loss. And here we've made 7 ticks, so 7 ticks into 5 goes 1.4. So we've made a bit more than what we're prepared to risk. So we've made nearly 1.5 times what we're prepared to risk as far as these trades are concerned. So what we want to do then is start working out a few things like strike rate, average winner, average loser. Okay, so that should be 8 trades for the month. Let me fix that up now. So 8 trades are taken. So that's a pretty easy one. Our winning percentage is 4 winning trades divided by 8 trades. We've got a winning strike rate of 50%. We've got a losing strike rate also of 50%. Okay. Now R multiples. So what we want to do is add up all the R multiples. So we add up 2 plus 1 plus 0.6 plus 2 plus 1.4. Add up all the winning trades. Whether it's anything from 1 tick to 50 ticks, whatever. If you physically made a profit, add it all up. In this particular case, the total R is 6. Okay. So on all these winning trades, we made 6R, meaning we made 6 times what we prepared to risk. Okay, but we took 4 trades to do that, 4 winning trades. So 6 divided by 4 equals 1.5. What that means is every time we take a winning trade, we make 1.5R, meaning whatever we risk, we make 1.5 times that. So we make 1.5 times 5 ticks. If your 5 ticks means you're risking $1,000, every time you take a winning trade, you find yourself in a situation where you make 1.5 times $1,000 or 5 ticks, whatever it might be. This is expectancy. Okay, on all the winning trades, we're making 1.5 times what we risk based on actual information. And then let's take all the losing trades. Obviously it's not always going to add up perfectly like this. That you're going to have some that are a bit bigger and all sorts of different fractions and things like that. But just wanted to keep it simple for this example. But we've got a -1R, 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 -1R. So we've got a total of 4R. Okay, divided by 4, obviously that equals 1. So on average, every time we're taking a losing trade, we're losing 1R. So we're losing our full amount of that we're prepared to risk. For example, with myself, I think I'm sitting about 0.7, 0.8R, because I take 5 tick as my full stop loss. But on average, I have some 2 tickers, some 3 tickers, some 5 tickers. When I average it all out, it averages out to about 4.2 ticks, or say about 0.8 of an R. When I average it all out based on many months of information. Okay, so let's take this data and put it over here. Okay, remembering this is the formula that we're using. So basically what we've determined here, our winners are 1.5 times the size of our losers. We win half the time. Okay, so our average winner is 1.5. Remember we worked out before, every time we win we're making 1.5 times what we're prepared to risk. Our average R winning situation is 1.5 multiplied by the fact that we win 50% of the time, so times that by 0.5. Okay, from that we want to subtract the losing side. So we worked out that when we lose, we're basically losing on average 1R. We worked it out, divided by 4, we're risking 1R. Times that by the fact that we're losing 50% of the time, and that determines our losing side of things. So we've got a situation now where we take into consideration strike rates. So based on how we're winning and losing, this is the type of R we're making. So when we take that away, we come away with 0.25, meaning our expectancy is 0.25 of what we risk. So what that means now is, on average, over a long period of time, every time we're taking a trade, doesn't matter whether it's a winning or a losing trade, when you average it all out, we're going to make about a quarter of what we risk every time. So if that's 5 ticks, we're making a bit over a tick every time. So if you imagine you take 200 trades in a year, on average we're going to make a bit over a tick. That's 200 ticks to make in a year. This is quite low expectancy. I want to use a very low amount. It's quite easy to get a system. All things aside for a second, mindset and things like that. But a good trader can easily get an expectancy of 0.25, where they're basically just winning half the time, and the winners are only 1.5 times the size of their losers. But hopefully you can start to see there now. We've worked out what our R multiple is based on our winning trades. We worked it based on our losing trades. We subtract the winning from the losers from the winners. We worked out that this is our expectancy. We're making 0.25 what we risk. Okay, so now we can use that and plug that into the expectancy model. Into the annual objective model. So just remember, it's basically working out your average figures. Okay, so, and the reason we put strike rate, we want to incorporate strike rate into it, is so we can come up with an overall figure. Okay, so we take a step earlier, 0.75 and 0.5. Do you understand what that means? Basically, this 0.75 figure, that's just to do with the winning side. So every time we're taking a winning trade, we stand to make 0.75 of what we risk based on percentages, because we're winning half the time. And then with losing, we're losing half of what we're prepared to risk, because we're losing half the time. And then you minus that, the losers from the winners, and we come up with a figure where you look at every single trade then, and we stand to make a quarter of what we risk. Like I said, I really suggest you go on it and find more information about this. I heard from a very successful trader once that if you don't understand expectancy, or if you don't know the expectancy of your trading model, so for example, if you just got a system and you're kind of just plugging away, you might be pretty sure of where to approach the market, but you haven't determined some of these factors as far as risk modeling is concerned, and you don't know the expectancy of your system, you've got a very slim chance of making it. This is what the professionals do, if you were to break it down and what the pros are doing, absolutely, without a shadow of a doubt, they'd understand this sort of thing and they'd know these figures. And it's kind of a little bit of a light bulb situation for me when it's, if you're looking for that something to get you over the hump, it's not to do with finding another system or a better entry. Like we said right at the beginning, entries are 10% or even less than 10% of making it as a successful trader. What's a lot more important is focusing on managing the trades better and then building a better mindset, which obviously comes from focusing on things like this. So this stuff is really, really important, that even if it's kind of a little bit harder to understand at this point because it's new and I'm doing my best job to explain it, but it's certainly something I had to research a little bit more and hopefully become a little bit clearer as we move on, and certainly part 3 where we plug in some more real life figures, hopefully they'll make it a bit clearer for you as well. But absolutely, this stuff is so important and you need to know it, and this is probably the thing that's holding you back as far as projecting yourself forward and really starting to make it as a professional trader. I know it's certainly made a difference to my mindset and how I looked at my trading. Put it another way, to make money, I've heard this mentioned many times. To make money, firstly, you have to have approach the market from a strictly mathematical perspective and understand a lot of these formulas. Wins, losses, at the end of the day, who really cares? Okay, it doesn't matter. All that matters is the math and the model that you build. Once you build a trading model and you create these risk models, you then have a way to get in and out of the market. So I pressed the pause button now. I think I left out a section. I'll go over it again. To put it another way, to make money, and I've heard this said many times, you firstly have to approach the market, from a very strictly mathematical perspective. At the end of the day, winners or losers, they don't really matter. Okay, all that matters is the math and the model that you build, so the risk model that you build around your entries. Once you build a trading model, and once you build a way to get in and out of the market that matches your model, the only thing left there then to do is simply take the trades. That's it. That's really the way that I try to approach trading is, I'm not trying to take winning trades or I'm not trying to take losing trades. I'm not doing anything except taking the trades that my model tells me to produce. And then if you've got something backing it all up like this risk modeling, you understand expectancy and what roughly what you get as far as the strike rate and expectancy in some of these figures that we're starting to go through. Well, then that's all that matters, and it becomes a lot easier job for you to keep on clicking that button. But at the end of the day, you just don't want to have a situation where it is about you. You want to create these models, then you're just there to execute them in the marketplace and let the model do all the work. So obviously, the more groundwork done now, the more effort you put in now, and getting these created, the better off you're going to be. And of course, then it's all about just tweaking them as you're moving along. And then by doing something like that, what it starts to do, what I found it did for me, is it really puts you at ease and it starts to separate you from your fears or egos or whatever it is that potentially makes, as humans, it makes it tough to keep on clicking that button. So it really starts to separate you from that information or that previous information. And what happens is people, when they win, they feel good because they feel they did it. When they lose, they feel bad or they feel crap because they feel like they've stuffed up. So the goal is to get all this stuff, understand all this, create these models, and let it separate you. So you're like I said, you're like that third party watching your system perform every day. And what that does, it really starts to empower you and releases you from that emotional up and down, all the pressure that we feel as humans from trading. And I never felt more at ease as to when you sort of get all this stuff done. You've got a system. Yes, of course, the system's important, but more importantly, you've created a risk model around that system that defines the parameters of exactly what you need to do. Then you, like I said before, all you need to do is just keep on clicking the button and let the models do the work. Okay, so let's have a look at what we've come in tonight to do and start having a look at the annual performance objective and plugging in some of these figures. Okay, so let's have a look at annual objective. Let me bring up a sheet here. I've drawn out this formula again. Have I? No, I haven't. Oh, sorry, that's the wrong sheet. Okay, here it is here, right up the top here. Annual objective equals trade frequency multiplied by position size times by expectancy. Okay, so let's just start off. I'm going to do 20%, 50%, 100%. Cover all perspectives, okay? And what we're working at is position sizing. So just keeping with my cursor here, I've got 20%. Okay, we know that we want to achieve 20% a year equals. Now what I've taken is a figure here of trade frequency, similar to me, 480 trades a year. That's an average of 10 trades a week times by 48 weeks in a year, having 4 weeks off. You might trade half that, double that, whatever it is. You should be able to quickly, it's quite an easy figure to work out, your annual trade frequency. Okay, position size we don't know yet, and 0.25. Remembering, basically we've got an expectancy where every time we take a trade, all we're making is a quarter of what we risk. Okay, so if I'm risking 5 ticks, basically every trade, whether it's win or loser, on average, I'm making 1 and a bit ticks. And just remember, as far as an expectancy figure, this is based on a system that wins half the time and makes 1.5 times its losses. As far as expectancy goes, that's very sort of underdone, very reasonable. The expectancy, you should be able to really achieve that. A good trader, of course, there's a lot of things to consider, mindset and all sorts of things, but just as far as creating something and getting that sort of expectancy, it doesn't take much of a system to get that. Many traders will have a trading expectancy a lot higher than that. Okay, so that's basically that formula with all the figures plugged in. Now it's just a matter of algebra, taking you back to your school days, as to working it out. So what we want to do is just break it down. So first thing I want to do is divide both sides by 480 to get rid of this figure. So divide this by 480, divide that by 480. So what I've done is 20% or 0.2 divided by 480 equals that figure there. So that means 0.000041666 equals, and knocked out that. So now we've got equals position size times by expectancy, 0.25. Again, divide both sides by that figure to knock out that. So what I'm going to do is take that figure, divide it by 0.25, our expectancy, and what we come up with is this, 0.001666664 equals position size. So it's just a matter of taking that, bringing the decimal place back a couple of times, and that will give us percentage. So what we come up with there is position sizing of 0.16%, meaning to achieve a 20% return, we should be risking 0.16%. So not 0.5%, not 1%, not even 1/4%. That's almost a tenth, or somewhere between 1/10 and 2/10 of percent. Many people, if you break it down, ask you, what are you risking at the moment? Obviously, this might not be your annual objective yet. We'll get a bit higher, but most people are risking 1, 2, maybe 2.5% per trade. This is saying to achieve 20% based on these figures, based on a reasonable expectancy, you just need to risk a 1/10 of a percent. Have a bit of a think about that for a second. Even if you're in a situation where you have 10 losing trades in a row, you're going to risk, what's that, about 15, 16% of your account. If you're risking 2%, 3%, and you have 10 losing trades, that's, sorry, I think taking a step back for a second, I should have said, when you're risking 0.16%, okay, 1/10 of a percent almost, or a bit more, 10 losing trades, equals 1.6% in total. Sorry, I think I said 15, 16%. I was completely wrong there. So 10 losing trades in a row, and you're risking 1 to 1.5% of your account. How would that make you feel? You think it'd be a lot easier to click that button? Bearing in mind we're only going for 20% at this particular stage. 10 trades in a row, we've worked out a possible losing streak of 10 trades because we're getting 50% right or something along those lines, and we stand, almost at a worst case scenario that we could risk 1.5% of our account. Have we worked out that right? Yeah, 1.5% of our account. Bit different to, say, risking 2% of your account per trade. You have 10 losing trades in a row, there's 20% gone. So a fifth of your account gone. Whereas here, at worst case, we're risking 1/100th or 1/50th of our account. Sorry, that was a little bit confusing for a start there, but I've worked it out in the end. But basically, what hopefully you'll get from this is that to achieve your annual objective and without being sort of too flash, you really don't have to risk that much, and quite often a lot less than you expect. And it comes back to risk spectrum, like we talked about earlier. You should be in a situation where, it really depends on the individual, but you're never in a situation where you're risking more than absolutely at max 2-3% of your account to make a 20% gain. Okay, so that's that scenario. Let's have a look at another one here. 50%. I've just taken the exact same thing, 50% now. So same figures, 480 trades, PS times by expectancy of 0.25, divide both sides by 48, gives us that figure there, 0.001041, equals position size times our expectancy. So divide both sides by expectancy, gives us that figure divided by that figure. So now we've got 0.004166 equals position size, meaning 0.4%. So to make 50% in a year, we should be risking less than 0.5% of our account. So again, 10 losing trades in a row, you're looking at it being maximum drawdown of 4%. Is that a little bit different to what you're currently looking at? And does it kind of scare you if you found yourself in a situation where you thought to make that sort of money you've got to really be risking, say, 2, 3, 4% of your account at any one time, and then you're looking at potentially wiping out a third or half of your account if you have a bit of a losing streak. You just want to get in a situation, and this comes back to maximum drawdown, where you know that what your possible worst losing streak could be, and you've already worked it out based on your position size, and you know what you stand to lose as far as max drawdown. I just want to, before we talk about 100%, I just want to focus on that maximum drawdown just for a second, because obviously that was back here. This was one of the variables as far as a central risk model. Okay, maximum drawdown to go with expectancy and strike rates and things like that. So let me just find that. So here's I just want to put a bit of a picture in your head of what I'm talking about here as far as maximum drawdown. So like we've already determined, we're creating a risk model. So we've got a very systematic approach. So you imagine you've got a very systematic approach, and you can then go back test the last 6 months of data or the last 1 year of data. Or if you don't want to do that, just start forward testing, start recording this information. Imagine you're 12 months down the track. Okay, after testing, your maximum losses in a row was 6 trades. This is an example I did a while back, but it might be 10 trades, it might be 20 trades, it doesn't really matter. But from this, you're not guessing now. So obviously with a trading system that strikes at about 50% of the time being right, you got a situation that you could get 10 losing trades in a row. That's pretty likely. But let's just not even use a scenario situation. Let's base it on a pure fact that over the last 12 months, for this example here, let's say you had 6 losing trades in a row. Okay, that was your worst losing streak. So you shouldn't really lose 6 times what you're prepared to risk, or 6R. As a rule of thumb, what we want to do is take our maximum losses, times it by 2, just to be sure. We want to cover our worst case scenarios. We never want to operate from a best case scenario. We want to operate from a worst case scenario. Okay. So now we've worked out that based on pure fact, the last 12 months we had 6 losing trades in a row. We've doubled it, and we've got a situation now where we shouldn't ever be in a situation where we get more than 12R loss or 12 losing trades in a row. Okay, so that's what I'm talking about before. Now you put that into this example here. Let me bring it up again. Okay, so we're risking 0.4%. We've worked out that's our position size. That's what we should be risking. Okay, our 1R, our maximum 1R loss is 0.4%. Now, based on that one there, we worked out double our worst potential losing streak. It's 12 trades, so 0.4 times by 12. So we should be in a situation where we never risk. That's 4.8% or 5%. Never more than 5% of our account to achieve 50%. And I hope that's starting to make sense. And this is all starting to plug in together now. So we're in a situation where we're understanding all these figures. Let me just scroll up to it again. Of our risk model. Okay, we're knowing our winning losing percentage. We're knowing our expectancy, average winner and average loser. So from that, with our expectancy times by winning losing percentage, we've got exact figures as what we stand to make and lose every single trade. We know our frequency of trades, and then we know our maximum drawdown. So we're starting to already understand exactly where we sit as a trader, and from that we're starting to gain a heap of confidence because we're basing everything on absolute fact and maths or science. It's not just a guess. Hopefully it's starting to become clear. Then of course, if we want to work it out for 100%, and I think most people, I turn up every year now. Not that I've been training that long, but I look at 100% as an annual objective for myself. Okay, so even based on these figures back here, if you're looking at 100%, you shouldn't be risking more than 0.8%. Okay, so again, if you times that by 12 trades, as far as an example of, that could be a maximum losing streak. That's, what's that, 8% plus 1.6, 9.6%. Again, it's less than 10%. Our absolute maximum drawdown should be 10% of our account to make 100% per annum. So all we've got to do, not all we've got to do, but you're starting to see now that we've got a systematic approach. We just got to keep on clicking that button, because that's what's going to produce the results. And we know we've predetermined a lot of things. We stand to be based in our system, have a maximum drawdown of 10%. We're okay with that. We're looking to achieve 100%. So even we're going to situations where we've got 5 losing trades in a row, 6 losing trades, 7 losing trades in a row, we've already understand that that's just part of the distribution of winners and losers. But it's in our best interest to keep on going and keep on clicking, because that's it's the only way to be successful. Is just to keep on going ahead with what you've created the model. It's not just about the entry. Hopefully you see now, it's the entry is a very small part of it, and the risk model, or the parameters that you've wrapped around those entry, is what's more important. If you sat down and started to really work all this stuff out, and in the third session, part 3 session, I'll bring them some real figures and some spreadsheets of what I personally do. But it's really worth your while doing this. It's obviously it's not going to something that it's not going to take overnight. It's not even going to take a week. It's going to take months and months of work and effort, and really putting yourself out there and trying to develop stuff. But once you kind of get all those parameters in place and all the models in place and the spreadsheets in place, all it's a matter of just keep on filling them in and keep on working with it and tinkering along, and then you can really start to get confidence in what you're building, and then it becomes like a machine. It's like a business, and that's what training's all about. And understand, I don't know if you sat down and 100% annual objective, even 50%, 50 to 100%. If we kind of get that in mind, and even if you start off small with a small amount of capital and you just grow up. But if you look at what you can do compounding based on 100% per annum, that just figure is massive. It's huge. It really is massive. And if you see yourself doing this, and where you're going to be in 5 years, 10 years, it just blows your mind. But the idea is you just have a very strict plan in place and give it the time, and just don't give up. And it's amazing where you can really start to take this thing once you give it the time and effort that it deserves. It's $1 million business you want to create. Everyone's different. You might want to create $10 million. You might want to create $100,000. I'm not sure. Whatever you want to do. Let's say, most people want to create, an example of a multi-million dollar business. Treat it like $1 million business. $1 million business has it needs a lot of planning, and needs a lot of these tight objectives put in place. It's not just something that you throw out there like a win on a prayer. It's going to be something that you really got to set yourself out to create and achieve. And when I look into it and do some research behind it, this is what all the professional traders do, and it's something I want to model myself on. So hopefully you get something from this and kind of see the same sort of picture I'm trying to put out there for you. And then just to finish off, I've just got one slide here just to finish off. The bottom line is, I think most traders, and this is, I was definitely the case. Most traders are risking too much per trade. Definitely me. I'll put my hand up and say I was definitely part of that category. Once I determined, based on my situation and based on math, what I should actually be trading, like I said before, man, I felt so much better, and it just makes so much more sense, and it's just so much easier to keep on clicking that button. Okay, so most traders are risking too much. Really have a look at that. Determine your annual objective. Determine what you should be trading. And then, smaller position sizes are really advantageous, because what happens is that, as you can imagine, there's less emotional stress, and it provides a foundation to really keep on building it and believing in yourself and believing that you can get bigger and bigger. I quite often sit down and imagine myself trading 50 contracts, 100 contracts plus. And when you truly think about that and think about almost the pressure that comes with that, knowing that your family's relying on you to create that income with those big contracts, it almost makes you shake a little bit in your boots. So obviously smaller position sizes and getting this sort of thing really down pat, and almost maybe even having a situation where the bigger you get, the less you risk. So it's almost you're just getting a greater and greater foundation. For me, that it's a really important step into me believing and understanding that I can absolutely do this and build that foundation, and that's where I really start to get confidence and believe in myself because I know I'm doing it based on the right things. Okay, so look out for part 3, and I'll do basically what we went through here, but just plug in some real figures. Talk to you soon.